I often try and pick the cheaper item if two products are the same. I don't understand why this is not the same with banking stocks. Obviously, some attributes of bank stocks, such as geopolitical stability, currency, and availability of common shares, make them less cut and dry compared to items in a grocery store. However, there are some very easy metrics that you can use to compare the value of banks and their ability to generate profit both now and in the future. And although the past performance of them does not determine the future results, it is useful in determining what their retained earnings will allow them to do. So, my favorite bank personally is Morgan Stanley, along with MFG, which is a Japanese bank. And the reason why I like MFG so much is the value. It has a value of three times the price of its share. So that means that, or let's say half, that means that if you bought one share for $2.49, it would be equal to about $5 of assets that the bank owns. And it's not like it's not profitable either. It's incredibly profitable. In fact, this year it's had a a record earnings report after a 18.6% profit margin allowed it to basically print cash during the pandemic while many banks struggled, especially in low interest rate environments. MFG has been in a low interest rate environment for like 10 years because Japanese interest rates do not go positive. And that's okay because if we look at the net interest rate margin, which is basically how profitable a bank is, as you can see, it has a very strong impact on the return on assets. Japan is at the very bottom. So why would their banks be able to have a better profit margin at 18.6% relative to Wells Fargo, an American bank that it benefits from the steeper yield curve and a better NIM, but it's only 16.53. And furthermore, its dividend is only 1.26. MFG, well, the dividend is 5%. So you tell me which is better value. Now, if I were to pick the upper end of banks and go with the luxury brand, I would definitely go with Morgan Stanley. What you get is what you buy in the sense that it does have a 25% or 22% profit margin, which is the best probably in the world. And it has one of the best asset management teams, and it has a dividend yield of 1.98. So that's not quite as good as the Japanese banks, and it is a little bit more expensive from a price to earnings and a price to book perspective, but that is not enough to justify the difference between 16% and 22% and a similar dividend yield for both Morgan Stanley and Wells Fargo, considering they both operate under the same yield curve. Now, what is the yield curve? The yield curve is basically a short-term interest rates over time as they get turned to longer interest rates, usually marked by the 30-day 7 to 10-year bonds and then 30-year bonds. They should get steeper. And the problem is with the Japanese yield curve is it looks very flat, and that equals minimal profit margin for a bank because this yield curve allows for banks to profit by buying the short-term treasuries at usually, let's say, 0.3% and then selling the long-term treasuries at 3%. And you can see that a NIM of somewhere between 2 and 4% or 3.5%, which is reasonable. Ideally, 3% is a very good NIM, will provide a much higher return on assets, likely double that of a NIM that's only at 2%. So that means that you don't just want higher rates, but you want higher rates in the 30 and 10-year interest rates as opposed to the short-term interest rates. And the benefits of a low rate environment that the Japanese banks operate in at the lowest end of the graph here means that these banks are ready for low yields, and they find other ways to cut costs and earn more profits. So that basically translates to a more robust and resilient company that's able to profit during periods of economic downturn, especially because it has lots of cash and not a lot of leverage. So it's able to buy up other banks, like the transaction that occurred where Morgan Stanley was purchased, a large percentage of it, I think it was 20%, was purchased by MUFG, a sister bank to MFG, and it still did not result in the price to book ratio reaching 1. Now, the price to book ratio is the share price relative to the value that you get from that one share in terms of accounting. So the accounting value of a company is very different and often a lot less than the value of the banks. But that's because their bank's ability to generate their profits from their assets through their NIM is priced into the value of the bank, and it determines the future outlook for the bank. And not just the bank's ability to make profit, but the bank as an investment for other people. Now, a 5.4% dividend, that's going to yield a lot more, even if this were to drop 2 or 3%. And it's going to yield more and provide more value per share than any of the major US banks, despite the US having a much better yield curve than Japan. Now, why is that? Because most of the debt that Japanese banks own is American debt. And the Japanese yield curve may be flat, and corporate Japan may be in a lot of, the government of Japan may be in a lot of debt, but corporate Japan is humming along nicely. And as you can see, it's actually outperforming many of the markets where debt and interest rates are less favorable now than they were for most of the time. Japan's been living in a low interest rate environment for a very long time, so it has no problem. Their banks have no problem dealing with a better interest or better yield curve and better rates because they're ready for it. They're strong and they have a lot of cash just in case, and they're very risk adverse, but that also hurts their profitability. That's why Morgan Stanley is able to benefit from the prudent management of cash reserves, from cheap debt by simply purchasing shares in the Japanese banks, and it has a price to book ratio that's much higher than 1. I believe it's probably somewhere above 2. So that means that it has the potential to fall a lot more if the perceived value changes and its ability to earn it drops. Whereas MUFG and MFG, they may not be able to make as much profit, but the value of their assets, aka their very large cash reserves, becomes a more valuable asset during a recession because you're able to buy all these companies and banks that are about to go under or that have gone down in price a lot. Now, the 5.4% dividend is arguably a sustainable alternative to long-term sovereign bonds because 2 or 3 years of 5% dividend payments and a very low likelihood of bankruptcy basically means that it's a hedge against inflation, it's a hedge against the US dollar depreciating, and it allows for the 5% payment to act as almost a replacement for bonds. Whereas US bank stocks, they're going to provide more price appreciation along with dividend payments, but they're also a lot more risky, and they have a tendency to struggle during economic recessions. They don't have nearly as much cash on hand, and their net profit margin is very dependent on the US yield curve, obviously, because the US yield curve not only determines the US bank's profit, but the global bank's profit, or banks around the world. It determines their profit margin through the NIM on US Treasuries. Now, I'll go more into banking stocks and how to find, or how to basically leverage your ability to profit from these banks and use them as tools to either generate income or protect against a recession. But that's going to be it for now, and hopefully everyone's able to get at least something from this video. Thanks a lot, and